Okay, so welcome to this webinar. The title is The Power of Compound Interest Over Time. And some of you might have heard me say this before. The compound interest is called the eighth wonder of the world. I think it was Albert Einstein that said that, because it's a powerful force that can help you achieve your investment objectives. So my goal today is to explain why, or discuss why it's important to start saving and investing early to take advantage of compound interest. That's number one. And number two, obviously, if you combine that now with saving in a tax efficient vehicle, that will also just obviously you'll reap big rewards over the long term. Okay, so here's the agenda. Let me just get my mouse in the right place. There we go. Excuse me. So we're going to discuss three things very broadly. What is your investment choices? What is compound interest? And what is tax efficiency? Obviously, we go into a bit more detail about the vehicles that you can use in that scenario. Okay. So to get started, it's important to know, and this is where I find a lot of people don't know. They want to invest, they want to make money, but they don't know why they want to invest. So it's a silly choice, a silly question to ask. What is your investment goal? But before you can get there, you also need to know what your investment choices. So investing can help you obviously keep up with growing inflation. And that's number one, and obviously to set and achieve your financial goals. In the next slide, we'll go into more details on that. So it's whether buying a car, owning a home, or obviously just planning for retirement. Investing can cater for your immediate as well as obviously your future needs. There are quite a few ways to invest your hard-earned money, and we'll be discussing some of those soon. But the terms of each investment, as well as obviously the net returns they offer on maturity, and the risks associated with each of them are different. And we'll, as I say, we'll explain or unpack these. There's no single form of investment that is suited for every investor. So you might want to have a bit of everything, a whole spectrum. Okay. So to get started, I always say there's three questions you need to know. What is your investment objective? What is the reason why you want to save? What's the reason why you want to invest? That's the number one goal you want to know. I find a lot of people don't have really that clarified for themselves. So is it, as I say, is it saving for a property? Is it saving for a house? Is it saving for a car, holiday, children's education, whatever the case might be? Have that goal in mind, number one. Is it just to create wealth? Is it a savings plan to create wealth? Or is it to have a happy retirement? Okay, so once you have that in place, then the next question is, what is your time horizon? In other words, term. What's your term? How long do you want to invest for? And how much do you need? That's another question you need to know. And then also very, very important, I'll be touching on this quite a lot in this presentation, what is your risk appetite? So just as a rule of thumb, very, as I say, rule of thumb, 1 to 3 years, we say that's short term. You don't want to take on too much risk here. So your main goal will be capital preservation. So you might have a more conservative risk appetite. So this is where the money market and income funds in the unit trust will come in handy. And historically, we're talking about 8% growth per annum. If your time horizon is 3 to 5 years, we say that's moderate. You can take on more of a moderate risk appetite. Yeah, your goal is more growth and income. You've maybe skewed more towards the balanced funds, and historically between 10 and 12%. And then if your time horizon, we say long term is 5 years plus, you might want to take on more moderate to aggressive risk. Something happens in the market, giving yourself time to recover. So yeah, we're talking about obviously more the equity funds, and historically long term, the stock market has always been the best investment rather, giving about 15% growth per annum. So it all depends on the factors, a whole lot of different factors. As I say, it's all based on, you can classify investments as along the lines of term, your time horizon, and obviously the risks. So we can split it into two. We talk about short-term risks, short-term investments, and then long-term investments. So we talk about putting money in the banks. We talk about savings deposit and call deposits. And the idea is mainly for, you're going for low returns, okay, because it's low risk. You must be aware of that. That's number one. It's a place just to park your money. People usually have a savings account or a call deposit, mainly for emergency funds or what they call a rainy day fund. Some of you people might have more fixed term deposits. This is more where um, it's a specified term to maturity. If you do withdraw before that, sometimes you are penalized. And then some investors will put into fixed income investments. So this is obviously to pay a regular income. So that's what they call short term. I don't want to spend too much time on that. Let's spend more time on this. This is where I call the growth investments. So long-term investments, these are, as I say, aimed at increasing your wealth over a longer period. We say 2 years plus, where short term will be anything 1 year as such. But they come with higher risk, obviously depending on the investment choice, and obviously more suitable for the long-term investor that's willing to withstand the ups and downs of the market. Long-term investors usually aim for higher returns, and consequently, with higher returns comes higher risk. So they work together. So the need of proper planning is important, number one, and number two, having in-depth knowledge of all these different investments, also very important. So there's very broadly, I say 5 different investment choices you can look at. Shares, another word for shares would be equities. Obviously, they represent the partial ownership of a business. So I always say there's 3 different kinds of shares. We talk about value stocks. This is what I call if you're a value investor, you're a bargain hunter, you're looking for shares trading lower than they're actually worth. They might be worth 10 Rand and you want to buy them for 5 Rand, that kind of stuff. So that's what we call a value investor. So a value investor or value stock generally obviously contrasts with a growth stock. Now a growth stock is something that's the company's growing so fast that they're also reinvesting again for more growth. So they don't pay out a lot of dividends. So it's low dividends. And then the third aspect would be you want to invest for high dividend paying companies. So this is where you want a regular income from your investment. And the idea here is that you, as I say, obviously want income. So you can have a hybrid of all different, all 3 value stocks and growth stocks and income stocks from dividends in one portfolio. That's one way of looking at it. You can also have exposure to long-term bonds. Obviously, this is another form of fixed income securities. These also bonds that are ideally 10 years plus. But here in South Africa, is a very small retail bond market is very small. So the easiest way to get hold of or get access to the bonds is through unit trusts, and that's the third point I want to highlight here. So obviously, unit trust, there's a whole lot of different securities you get involved in. When I say securities, obviously shares, property, money market, income funds, the whole hybrid, including the bonds. So yeah, the advantage of unit trust, and I'll touch on it again just now, is that you're pooling your funds with other investors, but you've got a fund manager that's managing the funds for you. And then very closely linked to a unit trust, the very same kind of idea, going through one fund, you're buying into a whole basket of stocks. Same with exchange traded funds. Through one share or one ETF, you're buying into a basket of funds like the Satrix 40, buying into the top 40 shares. And then another category long-term would be buying property. Most people buy a property for rental income, so they buy a property to rent out as a form of income. You can also have exposure to what we call REITs, real estate investment trusts. They trade like shares on the market. And then you also get, as I mentioned just now, having exposure to the property market through unit trusts. So these are all long-term vehicles. But I want to touch on today, just spend more time on the unit trust side, the benefits of investing in unit trust. There's a quote there from Koyonika. The more your money works for you, the less you have to work for your money. So the idea of unit trust is, as I say, someone you put your funds with everybody else, but a fund manager is doing the work for you. Okay. So the number one is obviously investment exposure. If you had to go buy, I mentioned just now the Satrix 40, if you had to buy each share in the top 40, first of all, you're going to have a lot of funds in each one of them, but your costs are going to be very high. But through unit trust, you can have exposures into any kind of markets, globally, locally, you name it. It's affordable. You can start a little 500 Rand a month. And I'll touch on it again just now on the next point there is rand cost averaging. If you're doing on a regular monthly basis, putting 500 Rand a month away, this is an example, 1,000 Rand a month away, you also take advantage of what we call rand cost averaging. And this is another form of wealth creation where you're buying, if you put 1,000 Rand into the market every month, you're buying units, for example, at 10 Rand, you're buying 100 units. Next month, it might have gone up a bit higher. It might have gone up 20%. It might be trading at 12 Rand a unit. So your 1,000 Rand only buy about 83 units. Okay, so that's like 16 units less because the price going up. But when the market goes up and down, over the long term, rand cost averaging does work in your favor. You're buying more units, and that's how you create wealth. And then obviously I mentioned just now, one way to manage risk is diversification. Instead of just buying one share and putting all eggs in one basket, you're buying into a basket of stocks, and that's diversification. And also I mentioned the professional fund manager is managing the funds for you. Okay. And then there's again, I mentioned just now with the putting the funds together, you'll also have the advantage of reduced costs and access to asset classes that you won't really have as a private investor, as I mentioned just now, the bond market. And then I found one of the bigger advantages also of unit trust is flexibility. Once you've got a unit trust portfolio, I can switch between different funds. So you're not just married to one stock or one unit trust all the time, you can switch. And then also if I want to sell, I want to withdraw my funds, you got liquidity. That whole price takes up to 3 days, and 2 more days later, you can have that money in your bank account. So you got liquidity. And also very important, that gives you that peace of mind. It's a regulated industry. Okay, so I just wanted to touch on that very, very quickly, the advantages of it. So let's talk about compound interest. As I said just now, it's the eighth wonder of the world. And the main idea I want to highlight here, if you start early, I know we've got a lot of investors on here. I don't think we've got too many young investors, but you can also relay this to your family, to your children. Whatever underlying fund or investment vehicle you choose, it's important that you commit to saving and starting early. Okay, you'll see a slide just now, the difference between starting 15 years later. So compound interest is a powerful force that can, as I say, help you to achieve your targets, but it becomes more pronounced over time. And this is best explained in a simple example. So first of all, before we get into compound interest, let me just explain what is compound interest. So first of all, you get simple interest and compound interest. So if you invest 1,000 Rand and you're earning 10% on that 1,000 Rand, and it's not compounded, so that's what we call simple interest. Basically, you're calculating it, your simple interest, just on your initial investment, your initial capital amount invested. So the principal does not get reinvested. That's a big difference here. It's not reinvested. Suppose 1,000 Rand in the bank, it earns a simple interest at 10% for over 3 years. So in your first year, you earn 10% on your 1,000 Rand is 100 Rand. Let me bring my cursor in here. And then obviously your second year, again, it's another 10% on your next 100 Rand, on your next 1,000 Rand. So on the same 1,000 Rand. So that's another 100 Rand. So it goes on. So after 3 years, you'll have your 300 Rand interest plus your 1,000 initial capital, plus it obviously adds up to 1,300 Rand. So the big difference here is it's just calculated on the initial capital. Now the compound interest, the thing here is where your money makes money, where your money earns interest. So it's exactly the same scenario, okay? But now the big thing here is that the interest is reinvested. Okay, so your 1,000 Rand, exactly the same thing. 1,000 Rand times 10%. In your first year, you'll have your 100 Rand. Okay, the next year you get invested again. So now you're earning 10% on 1,100 Rand. That's why we get 110 Rand. Reinvest again, and then you're earning 121 Rand in that. Over the long term, over the 3 years, you're earning 1,331 Rand. So the difference between the two of them doesn't sound a lot. It's only 3 years, okay? 31 Rand. But that starts compounding, and that's where the magic comes in. So as the term gets longer, that's where the big difference comes in. Okay, you'll see on the slides now. Just get rid of my cursor again. Okay, cool. Let me move on to the next one. Okay, so here we got two investors. You've got investor A, investor number one. At the age of 20, he starts investing a monthly contribution of 500 Rand. Okay, and his time horizon obviously until the age of 65. So he's investing for 45 years. So you can see his premium, his total contributions. This is 1.2 million. That's what he puts in. Okay, and we can see our assumptions here. We're growing 10% per annum, and we're adjusting it now for inflation at 6%. Okay, so at the age of 65, you would have had over nearly 8 million rand. That's his total investment returns. Okay, yeah, you got someone later at the age of 35, so 15 years later, or the age difference is 15 years, but for example, he only starts 15 years later. He has to invest, he's starting with 2,500 rand, which is 5 times more than this investor here. So you can see it's nearly double in contributions, okay? But you can see also just to get to the same result, okay, you can see 7.8. He has to invest 5 times more to get to the same investment. Just because this investor, number one, he started earlier. Okay, and that's where the big difference comes in, where the magic comes in with compounding. You also see another way of looking at this is visualizing. How much would you need to start investing to get to 10 million? So obviously, the younger you are, you can start with less. So yeah, around about at the age of 20, you started roughly about 500 rand. Okay, you can see over here at the age of 45, I have to put nearly 9,000 rand a month away. Yes, 500 rand, and you have to put nearly 9,000 rand a month away to get to my 10 million rand target. That's also a big difference. Okay, so the earlier you start, the better. Okay, I hope you guys are getting the idea that I'm harping on this. So let's talk about, so we've got the magic of compounding. Now let's talk about tax efficiency. Sorry, I'm just gonna get some water here. So we all have had to deal with a fair amount of change and uncertainty this year, but one constant remains is tax. Okay, and we'll see if there's any big changes in taxes with the budget speech in what's that, in about 45 minutes. Okay, at 2 o'clock. So what is tax efficiency? Well, tax efficiency is when an individual pays the least amount of taxes required by law. That's one way of looking at it. Alternatively, you can also look at it this way. Tax efficiency refers to the structuring of an investment so that it receives the least possible taxation. Okay, so that's what we call tax efficient. So are your investments tax efficient? So increased benefit of compounding is in a tax efficient vehicle like a retirement annuity or like a tax-free, obviously adds to the benefit of compounding. So let's talk about the tax-free. How does a tax-free savings plan help you create wealth? So the other idea, yeah, it's a flexible investment, and your investment, your returns are not taxed. So any capital gains, any growth you get from your investment, okay, is not taxed. Even if you switching between funds and things like that, or you disinvest, you take the money out, there's no tax. So any growth in income, be it from interest or dividends, is tax-free. Okay, so all these tax benefits add up again over the long term, especially if you reinvest into higher growth assets, like having exposure to the equity market and things like that, and you remain invested for the long term. So that's number one. Number two, here's just to explain to you the big advantage here. And this is just comparing a tax-free to a normal unit trust, what we call a voluntary investment plan. So there's some assumptions here. The maximum, okay, maximum you can put into a tax-free right now is 36,000 Rand a year with a lifetime limit of 500,000. So this is what we assumed in this scenario here, number one. So the annual contributions will cease once we hit that lifetime limit. So around about 15 years, you see that you'll reach that 500,000 limit in contributions. So with the VIP, or the voluntary investment plan, we're assuming that the maximum CGT tax exemption is obviously taken into consideration each year, at the end of each year, and also the maximum tax rate of 45% has been applied. But you can see in all three scenarios here, okay, 10 years, 15 years, and 20 years over the long term, okay, depending on doesn't matter really what growth you're looking at. We're talking about 10, 12, and 50% growth. Just the tax benefit is helps big time. So it's another way of leveraging your wealth. Yeah. So let's talk about how this can tailor it to suit your needs. As I just now, it's designed to suit your needs. You know, there's no your asset allocation is flexible. There's no regulation 28 in place like we have with a retirement annuity. There's no restriction on asset classes. Now, with a regulation 28, you can have more than 75% exposure to equities, for example. So your contributions are limited at this point in time to 36,000 a year. As I say, also has 500,000 for the lifetime. You can withdraw these funds all the time, anytime you want to. As I say, but you can't put it back. That's the main thing. You're not added back. You can't add it back to your annual or your what I call lifetime limits. If the contributions do exceed that 36,000, you will be penalized. You'll be taxed at 40%. So, say for example, you're putting 40,000, so you're 4,000 over that limit. 40% of that you'll be taxed 1,600. I think the systems will not allow you to go over that anyway. That's one of the precautions that you might have in place for you. So, when it comes to retirement annuity, you can invest up to 27.5% of your income, your remuneration into a retirement annuity. So this obviously, the taxable income or remuneration comes from various sources, can be from your salary, from a bonus, commission, rental income, interest, and foreign dividends. So in our example, I'm going to use 500,000. You calculate the maximum tax deductible, as I say, 27.5% on that, which by the way, it's kept at 350,000 per annum. But you're getting every time you have a contribution, it's tax deductible. So 27.5% on 500,000 is 137,500. So before a RA contribution, your tax payable would have been 110,000 rand. Tax payable after the RA contribution is only 64,000. So the big difference there, you're saving yourself 45,000 rand a year just by using the RA and using what SARS is giving you as a tax efficient vehicle. What happens if you go over this amount? Obviously, you can carry these disallowed amounts into the next year. Okay, that's number one. Number two, obviously, you can lower the tax lump sum at retirement. So your first 500,000 can be taken out as tax-free, but also obviously you can take out more if you have gone over the limit. And also, you can also reduce your taxable portion of your annuity income if you've gone over that limit. So there's some nice benefits to look into it. Now, I want to just highlight some factors that you might have to take in consideration when you compare the two. Some questions as such. This helps you also to decide which ones you want to have. My suggestion is to have both. Use the tax-free to complement or supplement your retirement annuity. So first of all, who's the product for? It's for individuals. In both scenarios, individuals, not for companies and not for trusts. Are there any age restrictions? No. Are the contributions tax deductible? Yes, for the retirement annuity, as I mentioned now, 27.5%, which is obviously greater of the taxable income or remuneration, capped at 350,000. But with the tax-free, no, it's not tax deductible. Are the contribution limits? Yes. As I mentioned, the tax-free, it's limited to 36,000 with a lifetime of 500,000. But with the retirement annuity, no. Okay. What's the minimum contributions you can make? 600,000 lump sums, 20,000 with RA, and you can see there you can start with both 500 Rand a month. Okay. Can I access my investment at any time with tax-free? Yes. With retirement annuity, no. And this is what I think one of the big advantages of a retirement annuity is what I call disciplined savings. So you're forced to invest, and the only way you can have access to that funds is at the age of 55, or when you emigrate, or early retirement due to ill health, or if the fund value is below 7,000 Rand. Okay, but it's a nice way to start saving for retirement because you can't get your hands on it. Okay. Are taxes payable when I access my investment? With tax-free, no. With the retirement annuity, yes. Lump sums are taken they are taxed according to the retirement tax lump sum tables. So say the first 500,000 is tax-free. Thereafter, obviously, it's on the tax tables. Annuity income will be taxed as normal income tax. Does the investment form part of my deceased estate? Yes, with a tax-free. No, with a retirement annuity. Big advantage there also. Is the investment protected from my creditors? No. From a tax-free point of view, and very important from a retirement annuity. So those of you that are business owners, something to look at. Okay, your creditors cannot attach your retirement annuity. Are executive fees payable? Yes, with a tax-free. No, with a retirement annuity. Okay. And what kind of funds can I invest into? There's a whole range of unit trusts you can invest into. The tax-free is about, I think it's what last I saw was about 94. Same with the unit trusts that are Regulation 28. There's a range of funds to choose from. Is Regulation 28 applicable? Obviously, mainly for the retirement annuity. Okay, so guys, I went through this very quickly because of time constraints, but main thing on the highlights for you guys before I handle any questions, most important thing when it comes to investing is to make a start. Okay, that's number one. And obviously tax efficient savings should be part of your holistic financial plan. And then when I mentioned the word discipline just now, financial discipline doesn't have to be intimidating principle. Just start small, and small actions do add up. And as I mentioned just now, is there are other factors to take into consideration if you want to compare the two together. Okay, so from my side, guys, thank you very much. Just in conclusion, there's a quote here from Bogle. Okay, time is your friend, impulse is your enemy. Okay, so it might be too late if you want to still want to transfer funds into the account. I think today's the last day to transfer funds into your RA and into your tax-free. The cutoff's today. Those of you that haven't got one into yet, I think it'll be too late for this current tax year. You can start for next year. So if you want more information on our tax-free, you can click on this little link here. It takes you to the page, as well as our retirement annuity. So this presentation, as I say, is being recorded. I will be seeing it out most probably by Friday morning. Okay. So let me see what kind of questions you guys have. Cool. Yeah. Questions. Yeah, that's a question. Yeah. Can I have a tax-free and an RA? Yes. Just two separate registrations. Go through the whole process, register for the tax-free, register for the retirement annuity, and obviously the FICA process. Yeah, it might be, as I say, it might be too late now to take advantage of the current tax season, so the cutoff's today. But you'll be ready for next year. Which of the product, there's a question from Hammond, which of the products do you mention brings the benefits of compounding? Both products, Hammond. So if you're investing in the underlying investments into unit trust, depending what funds, what vehicle you're using, or be it equities and that, the funds are using compounding. The fund manager is making decisions and he's reinvesting the growth. So that's where the compounding comes into it. Vessel, yeah, tax-free investments didn't perform too well the past couple of years. The last 5 years, anything related to the stock market, equity market exposure, yeah, hasn't been very well. But obviously, the people that had exposure to the money market funds and the income funds did pretty well. Okay, so yes, but as I say, you got the advantage of flexibility. You can switch between funds and things like that. But remember, you still got the advantage. Whatever growth there was, is still tax-free. Herman, yeah, to answer your question, perhaps asked a different way, do unit trust funds compound monthly? Is it different between different products? It's not so much different products. I think it's more different asset classes. Now, if you're in a money market fund or income fund, that is monthly. I know that a lot of the property funds pay out quarterly interest. Obviously, a lot of the shares pay out dividends. That gets reinvested also. So different things differently. Okay, Evan, pleasure. Vessel, I'm not 100% sure what you mean by that, but maybe I must give you a call and we can talk about it. So guys, look like that's all the questions from my side. Awesome. Great. Guys, thank you very much for being on the webinar. So the recording and the presentation will be seen out by Friday morning, hopefully. But from my side, if you want to contact us, there's our email address, our box, wealth@psg.co.za. You can also get us on the toll-free 0860 000 368. From my side, thank you very much. Until next month, all the best. Bye for now.